Hello and welcome to another installment of our market updates. Today is June 25th, 2020, and we are today discussing investors caught in the crossfire. It is a unique environment out there, to say the least. So we want to dig into the things that are making it unique and where we see some green shoots moving forward. But before we do, let's talk a little bit about the blog. If you have not seen the estate planning video that was recorded in the video on recent developments in real estate amid COVID, I'd encourage you to take a look, especially now, given as we keep moving through, we get more data, we're seeing more economic development. Some of these things are getting greater context and some interesting confirmation of things that we had said previously, but in particular with relating to the estate planning, that is COVID or no COVID, that's very important content and material to have in your plan. And if you do not have current documents or documents that express your wishes, there's certainly opportunity for some disappointment, if not just on your side, but on your families. So we hope that we can help you take care of that. If you have not, again, just head out to deandrefinancial.com/media, and you can take a look at those videos, and we can help you out with that. So moving on, this recession is not normal. Okay, so despite what we see in the news from time to time, and what I mean by that is referring or comparing today's recession numbers or today's economic numbers to past recessions. It's nonsensical to me. I don't see how that makes any sense and how it makes for viable comparisons, other than maybe anecdotal information. But what we're looking at is a reaction to a medical situation, not your typical economic response. So typically when we have an issue economically, you're going to see a breakdown in one of these or more than one of these five pillars, either Fed policy, tax policy, regulation, spending, or trade. And right now, four of these five are really doing rather well. We have no issue with Fed policy. Tax policy is the best it's been from a corporate standpoint in many, many years. Regulation is significantly down. Trade is positive, although maybe still a bit stressed because of the virus, but trade is still in a better position than it was a year ago. And spending is the only thing that you could really come back to and say, hey, we have an issue with spending, because the government is spending a ton of money right now. But of the five pillars, four of them check out okay. So this is not your normal type of recession, and to assume or to consider it so, I don't think is really an accurate perspective. So let's take a look at some of the data, kind of persuading us to see this from the sort of odd perspective that this is. So I'm going to open these up so we can get a better view. The United States, this is personal spending. This low down here is in April, and it is forecast to be about 9 for the May number. But as you can see, well outside of the normal range that you would see for personal spending. If we go to jobless claims, initial jobless claims, this chart goes all the way back to 1970 over here, and you see this massive, massive spike on jobless claims. And just for some perspective, in a 3-week period in April, there were over 17 million jobless claims. In an 18-month period during the Great Recession from 2007 to 2009, claims totaled 9.6 million. So 17 million in 3 weeks of this virus environment versus 9.6 million during the Great Recession, just to give you some perspective. Gasoline prices obviously slammed as people are staying home, and what you saw with the demand drop in the supply glut in oil. Clothing stores, I mean, how many pairs of sweatpants can you buy right now, right? So clothing, way off, going back to 2000, and as far as you could take these numbers out, way off. Restaurants and eating places. So while things are opening up a little bit on the restaurant side, still way off. These numbers don't resemble any type of recessionary period that you could ever find. These are purely virus reaction numbers. Food and beverage stores. Okay, so this is basically your grocery shopping. I mean, that's not all toilet paper. Okay, we're eating at home. Massive spike, massive change in behavior, and again, totally out of character, totally out of the norm response to the circumstance. Department store sales. Okay, so this is your JCPenney or Macy's, these types of places where you would go and do shopping at department stores. The trend has been negative for many years, is going back to 1998, but this virus just really pushed it over a cliff. And there will be some rebound as there will be in most of these economic indicators, but some of these places aren't going to come back. And sort of as a corollary, you have non-store retail, which you could think of as your on-site curbside or your straight online ordering, seeing just a massive amount of growth through this period of time. Again, not in the normal trend, not in the normal circumstance at all, but just an exponential number of growth in that non-store retail area. And then as you've probably seen, if you've been to a home goods store, a place where you could buy mulch and grass seed and bushes and paint and things of that nature. Those stores are hopping. People are home. They've got some extra money in their pocket, in some cases if they're working, and they are going out and spending money at these types of suppliers. And then we have this Chicago Fed National Activity Index, which is sort of a cumulative view, although it's not a true aggregate index. It considers 85 economic indicators from 4 areas of the economy. So production and income, employment and unemployment and hours, personal consumption and housing, sales, orders, and inventories. And it basically aggregates that, and it gives it a value that if it's a positive value, you have a growing economy. If it's a negative value, you could have a falling economy. And as you see, it generally is trending in a fairly narrow range. It had some extreme action in 2009 coming out of the Great Recession, and a little bit here in the 70s. But for the most part, it just sort of meanders to the right until now, where we've seen a record pullback and then a record high all within 60 days. So this is certainly not our normal economic situation. But do not be afraid. We have good news. Actually zip through to this slide here. All we have to do to fix any of our woes is simply stop Googling bad things. Okay, so here's a chart that this blue line is the inverse of Google interest for coronavirus in the United States. So as the more, and this is an inverted chart, so if you flipped it back to its normal side, you would see it peaking. But the more we searched Google, the more the market went down, and the more we searched coronavirus, the more the market went down. The less we searched coronavirus, the market came back up. So anything that ails us as a nation or as us individually, simply stop Googling it, and everything will be just fine. Okay, so now on to some more sensible information. So I want to chat a little bit about some relative strength readings that we're seeing in the market. This is a much more data-driven, unemotional, unnews-driven process for security selection as we're trying to manage assets and manage and grow wealth throughout this process. And that relative strength ranking can be considered and thought of as an arm wrestling match. And you'll hear me refer to it from time to time as an arm wrestling match. So whether you're taking cash versus bonds, stocks versus bonds, gold versus equities, commodities versus currencies, any 2 items, any X, any Y, and comparing them to themselves to look to see which has the stronger price performance, which is the stronger asset. And so we do this on a daily basis with all of the available assets in our investable universe to see where the market is going, where it has been, and where we can best position ourselves for the future to capture any potential economic wind that may blow as it goes. So what we see here right now is that U.S. equity is ranking 82.39% against all assets, and cash is still at under 50, right around 32.39%. So for a very brief time, cash flirted with 50, popped over just for a few days, and then retraced back down. Core equity, though, really never gave up its strong dominant position. So in a more defensive environment, you would see cash really take off and be a much higher ranking asset, and you'd see domestic equities selling off, not sort of in that extreme violent panic virus environment that we had, but more of a sustainable weakening before we would consider really trimming exposure and really being in a situation where we have to play significant defense across the portfolios. Never got that signal. We got some cash readings that were close, but the core equity market, although it didn't feel great all the time, still held up and held up well, and we're glad we stayed with that signal, because the V-shaped bounce that we got out of it has been very helpful to bringing us back to where we were at the beginning of the year, if not mid-February. So as it stands today, as of actually yesterday, the 24th, cash is ranking around 32, and U.S. equity, core equity, around 82. So let's look at size and style. It's been a growth-based market for many, many months, and that has not changed. As you can see, we have large cap, mid cap, and small cap growth all in the top leading positions. And then you get large cap blend, mid cap blend, and large cap value, which really is, it's had a couple of weeks of asserting itself a little bit, sort of testing the waters, but it has not been able to overtake large cap growth really with any meaningful data. There have been a couple stocks that on the value side that have had some a couple of good showings of late, but nothing of critical mass. And we want to tilt our portfolios towards the strength. We want to be leaning towards the green of this market. And it's been growth for a while, and it still is growth today. So we've had a couple of situations where we've tweaked a couple of positions, but there have not been wholesale rotations across models. We were well positioned going into this, and when we did not see anything changing in the rankings as we were going through this this correction, this environment, this virus environment, fortunately, we didn't have to make we didn't have to go into other areas for equity exposure. We were able to stay with a lot of the same positions that we had. We did sell some positions to generate some tax losses, and be able to capture some losses at the beginning of the year. That process is typically done in December, late November. It could very well be that in November and December we don't have any losses to take anymore, unless you really owned a lot of value stocks. I don't know. But sometimes you have to take your losses when you get them, instead of assuming they're going to be there at the end of the year to try and be efficient with your taxes. And so we did that over the last 60 days with a couple of trades, but mostly trading one type of growth investment for another, rather than switching from growth to value or core in the holdings. Also, from a sector standpoint, and I do enjoy being able to concentrate into sectors when there is dispersion among the sectors, and technology has just been a great place to be for a few years now, and still is today. Energy is ranking in first position, but it's the characteristics of energy today are significantly more volatile than technology. So very few positions and very little exposure is in across the portfolios in energy, but significant positions in technology, communication services, a little bit in the biotech space under healthcare. But again, staying in the mindset of investing in the strength of the marketplace, rather than just sort of spreading it wide and hoping that things work out, identifying the strength and leaning towards that strength as we go. So again, where we're kind of positioned, large cap and mid cap growth, large cap blend, and technology is how we're positioned today. Now, why is this important? Okay, so it all sounds interesting, but then when you really start peeling back the onion, in this case, we're looking at the S&P 500, the SPX index, and that is made up of individual sectors. We have information technology, communication services, consumer discretionary, healthcare, staples, materials, real estate, utilities, industrials, financials, and energy. Okay, and the index is off 4.5%, 5%, something like that on a year-to-date basis. But there are really only 3 underlying sectors that are even positive for the year. Healthcare is almost there, right around down almost 2%. But unless you're in technology, communication services, and consumer discretionary as a sector, you're negative year to date. So understanding where the underlying strength and weakness is, even within just the S&P 500. Again, we're not talking commodities, currencies, we're not talking international, emerging markets, we're not talking any of those things. We're just looking at the S&P 500 and saying, okay, where are the places maybe to concentrate in, but then also where are the places to avoid? And in this type of environment, there's a lot of dispersion between the best performing and the weakest asset classes, and this is an opportunity where relative strength can add some value. There has been volatility everywhere, but the relative strength can still help us stay on balance in the strongest portions as we move forward. So, economic green shoots. Let's take a gander here at how things are doing from an economic standpoint. Again, we're really talking about this dichotomy and this crossfire between kind of very interesting negative economic situations contrasted against a strong equity recovery, a strong equity bounce, a V-shaped recovery, however we want to look at it. And so this is the S&P 500, and here you can see our February highs pulling back into late March and then recovering rather quickly. If you took a long nap and woke up in June, you'd have been like, "What the heck? What happened? What was all the hubbub about?" We're back where we were, around the beginning of the year. But if you weren't asleep for those 3 months, it didn't feel that way. It was a pretty stressful environment. So we're finding these green shoots in the economy, though. So just because stocks have recovered doesn't mean the whole economy is there. So this is a TSA checkpoint data. This comes directly from TSA.gov. And if you look at the blue line, that is the consecutive weeks looking back. And then the orange line is a year from those last weeks. So a year ago, there were about 2.5 million people going through a TSA checkpoint this week 1 year ago. This week, there's about 500,000. Okay, so we're 2 million off on travelers, but we're well off the 87,000 low that we had back here in April, where traveling virtually came to a halt. So again, these are green shoots. These aren't established trends yet. These aren't all is clear when it comes to airline and travel, but or in hotel reservations. But these are all moving off their bottom versus continuing to trade lower or trend lower. Also, we have open table reservations. So 60% of the restaurants that use open table are taking reservations, okay? Up significantly from where we were in April, where there are basically no reservations being taken on open table. And we know the carnage that's taken place in the restaurant business. So this can't really happen soon enough. I think there's a lot of pent-up demand from consumers who want to go eat out and want to patronize these restaurants and want to do takeout and things of that nature. So to have the opportunity to go out either with outdoor dining or 50% occupancy, it's a really good sign. And I know personally we've enjoyed a couple of evenings out, but this is, again, green shoots. We're not there yet. It's not done, but it's green shoots. It's a good start to the trend beginning to reverse in this regard. So an interesting article on June 10th in the New York Times. How's the economy doing? Well, watch the dentists. So dentists have a rather unique career. There's not a whole lot of places you can go to have your teeth cleaned and cavities filled and caps and all the types of things that dentists do. So they have a rather unique space in the market. And they also were extremely sensitive to COVID. They're basically sitting in front of an open mouth all day long with their hygienists and their teams and their techs and their staff. And dental offices, are usually very busy places, very well-traveled places, tons of people in the waiting room, and they're kind of not a good place to be in a respiratory spread virus environment, or at least back in April when this was really we weren't so sure, I guess, on what to expect from this. But if you look in March, we had about 22% of the staffs in dental offices employed, to a low of about 11 in early April, and then as of June 1st, about 70, almost 80% of dental offices were sort of back and working. So that's another sort of encouraging sign from a very narrow and specific view of the economy, specifically dental offices. But again, these are the green shoots we're kind of looking for in a return to normal in the economy. Annual ticket sales. So this is movie tickets. Movie tickets obviously had movie gate and movie attendance has been very difficult. Most of them have been shut down. The places that are starting to open, there's some debate over masks or no masks and how many people and how are they going to be spaced and things of that nature. But from last week to this week, ticket sales are up 130%. Again, no one's saying this is the perfect scenario, but it's green shoots. Okay. So we looked at this chart earlier. This is the initial jobless claims. Okay, and we saw it from looking back from 1970 to yesterday, and it paints a pretty stark picture. But the positive side to this is that the number's been steadily coming down for 11 weeks. So that trend needs to continue. We'd like to see that obviously get down into the lower, more normal ranges that we see. It's not going to happen overnight. It's not going to happen in a week. But 11 straight weeks of declining initial jobless claims is a positive thing and something that we can consider as green shoots. Also, the M2 money supply. This is basically. Now let me just read this so that we're not confusing anybody, because M1 and M2 can get confusing. But basically, M1 is everything. M2 is everything that's in M1 plus everything that's near money. Okay, so you can think of it as all cash, and then anything that's easily converted into cash or quickly converted into cash. So it gives you an idea of the money supply that's in the economy right now. And if you look back here, let me give you a better screen here. If you look, you'll see that during the Great Recession, there was a great deal of fiscal stimulus. There was TARP, TALF, QE, QE2, all sorts of these things where the government was spending money. The Federal Reserve was pumping cash into the system, but there was really never a big M2 money spike. And in this environment, very quickly, we've seen an M2 money spike, okay? And that is that dry powder that can help this recovery be quicker and more sustainable. There will be some delicate maneuvering to avoid some inflationary issues, but right now a little inflation is better than deflation, and we're not seeing inflation yet, by the way, but in a few years we could see some of the the inflation boogeyman peak out just a little bit due to this, but you're either going to have deflation or inflation. There's no way about it. And to the stand that the Federal Reserve has taken, regardless of what opinions we may have of it, is that sort of a not on my watch. This thing's not going to crater now. They're going to do everything they can to support prices, equity prices, and keep markets moving, keep them lubricated and moving well. For a few weeks there, things were a bit disjointed, with especially short-term debt, things of that nature. But things like this are helping from a economic, or at least an equity market and fixed income market standpoint. So, digging a little more into the Fed and what the Fed is doing. Here we see the Fed funds target rate in this chart down here, and it was at 0 coming out of the Great Recession, and it wasn't until 2015, when unemployment hit around 5%, that we saw the Fed begin to raise rates. The virus comes out, and there was a little bit of easing as we were going through 19, but obviously the lockdowns accelerated that significantly, and now we're sitting at 0 rates. So as far as some projections from the Federal Reserve, they do not expect short-term rates to rise until at least 2023, and that's like no governors indicated that they were interested in raising rates for quite some time. Median estimate is that the unemployment rate will finish around in 2022 at around 5.5%. So that's about how long they think it's going to take us to get to sort of a normal unemployment, although that target unemployment rate's around 4.1%. So that we would not be sort of fully recovered by then from an employment standpoint, but well on our way by 2022. From a recession standpoint, we're kind of halfway there, where there's a deep recession followed by above trend growth with no permanent damage to GDP. So basically, we have this virus, we have a strong response, and we'll call it strong. We have a shutdown and then a response from the Federal Reserve, and then the projection is that this basically returns to normal as the virus pulls back, and we move through unwinding this Fed spending. And then inflation is really not expected to be a problem in the immediate future. So we have a situation where there's some when your restaurant can only have half its seats, you've created you put a restriction on supply. You can only have so many people in the restaurant. There's only so much supply that can come in, but there's a lot of people that want to go eat. So prices are likely to go up in restaurants. Prices are likely to go up at the movies. If there's talk of the NBA and Disney, and I don't know if there'll be any way to go to those games, but they're not going to sell out venues, and there's not going to be lots of people shoulder to shoulder. So prices are going to go up as demand is rising, and the supply is kept down artificially. So that is going to inherently bring a little bit of inflation. How broad will that inflation be? We'll have to see. It's obviously part of the mandate to not have runaway inflation or hyperinflation come out of this. And right now, there's nothing that would indicate that we're in that situation. But just something to be mindful of as we move forward. So this is really where we are from a key takeaway standpoint. Relative strength picture is still strong. The relationship between cash and equities is in the way that we would want to see it. It's in a posture which gives us the probability for positive things to happen. The Fed is still supportive and anticipating to be for quite some time, and the green shoots are growing. So while those things are happening, from an investor, it's sometimes difficult emotionally to separate ourselves from what's happening in the economy to what's happening in the stock market. And they are two completely different animals. They're two different scenarios, and they require different processes to take advantage of the opportunities that are going to come from either one. And that's where investors really do likely feel like they're caught in the crossfire, where the economic news is all terrible, and yet equities have recovered strongly. So as long as equities continue to perform well, outperform their peers, there's no reason not to own them. If that picture changes, and the relative strength picture will tell us that, the relative strength scores will tell us that, we'll react accordingly. Again, check out the blog, deandrefinancial.com/media. Review those estate planning documents. Those are practical, simple things that can be done to help take some pain and stress out of your household. And we hope that you have an excellent week. Take care.